Inflation is a rather frightening concept, particularly for business owners. The question on many minds is whether businesses can endure in an environment of soaring inflation rates. According to billionaire Bill Ackman, it's his viewpoint that inflation will persist at elevated levels, and this change might not just be limited to the near future, but could potentially manifest within weeks, possibly bringing about substantial shifts in the long-term economic landscape. Welcome to Nova Society, the heartbeat of personal finance. Are you already part of our subscriber squad? If not, we'd love to have you on board. Join us now. Prominent billionaire investor Bill Ackman recently expressed concerns regarding the future of inflation. However, there's no need to fret because there's some positive information to follow, which we'll delve into shortly. Bill Ackman recently participated in a comprehensive sit-down interview, and while the conversation covered a broad spectrum of subjects, it was his remarks regarding inflation that particularly piqued the interest of the public. So you don't want to miss out and listen to what he had to say.
I think, again, my view is inflation, or kind of the house view is inflation is going to be persistently higher.
Well, you are the house.
But I guess I control the door on the way in and out, I guess. But, our view is really that we're in a different world. And, the world sort of changes gradually. And you have a generation of people who are used to rates, 4 sounding like a high interest rate, and it's, on a historical basis, it's an extremely low rate of interest. So I would not be shocked to see, 30-year rates well into the, through the 5 barrier, and you could see the 10-year approach 5.
Jamie
and that can happen in the very short term, like literally weeks. We've seen a huge move in the last number of weeks, and I think a lot of that is investors kind of rethinking. What's interesting about the 30-year Treasury is people reflexively buy it whenever they, because they've made money doing it in advance of a recession. But it's really not an instrument you should use to speculate on the short-term economy. It's a fixed price contract with the U.S. government.
In recent years, we've witnessed inflation rates that haven't been witnessed in many generations. In June 2022, inflation reached a peak of 9.1%. To find a time when inflation was as high as this, we need to go back approximately 40 years to the early 1980s. It had been decades since inflation was a real concern for the US economy. It's quite astonishing to contemplate, especially considering that just a few years ago, economists were more concerned about inflation being too low. Observe this chart depicting inflation in the United States over the last 2 decades. Pay particular attention to the period from 2009 to 2020. During most of this time frame, inflation remained very close to 0%. There were instances when inflation was negative or hovered around 0% multiple times throughout the decade. This situation led to concerns among governments, businesses, and individuals, not about inflation, but about deflation. Deflation is the decline in the general price level of goods and services, or simpler terms, it's negative inflation. While this may initially sound appealing, deflation does present its own set of significant challenges. To prevent the United States from falling into a state of deflation, the US Federal Reserve set a target annual inflation rate of 2% in 2012. However, for much of the following 8 years, the Fed faced difficulties in achieving this 2% target. Consequently, many economists started to believe that inflation would no longer pose a concern in the United States. But as we've seen, things can change dramatically, and they certainly did in a significant manner in 2020. To understand why Ackman believes inflation is a persistent issue, it's crucial to comprehend the root causes of inflation. Put simply, inflation occurs when the demand for goods or services surpasses the available supply. While this might initially sound complex, it's quite straightforward. Here is a supply and demand graph. The line you see here represents the demand for a specific product or service. In this example, let's consider the context of a house that is in a bidding process. The demand line represents the number of individuals interested in buying the house and, significantly, how much those potential buyers are willing and financially capable of paying. On the other hand, the supply line represents the quantity of houses in bidding that are currently available for purchase at any given time. The point where these two lines intersect indicates the price for that product or service. In this case, it represents the average price of a second-hand house during 2020 and 2021. The US government and the Federal Reserve took dramatic measures during 2020 and 2021 to prevent a widespread economic collapse. These measures included directly providing funds to households, enhancing unemployment benefits, and temporarily suspending required payments on certain types of debts. While this financial influx was occurring, the Fed drastically reduced interest rates to historically low levels. These lower interest rates made it less costly for both individuals and businesses to borrow money for various purchases. To return to our example involving auctioned houses, these actions resulted in an increased demand for used houses. People had more funds available in their bank accounts, which enabled them to make purchases. Furthermore, the reduced interest rates made it more affordable to acquire a house through a loan. All these factors contributed to an uptick in demand, which is illustrated by our demand line shifting to the right. Simultaneously, housing or real estate companies grappled with supply chain challenges that limited their capacity to sell new houses, since fewer new houses were available. People retained their current houses for more extended periods, leading to a decreased supply of second-hand houses available for sale. This reduced supply causes our supply line to shift to the left. Now, if you observe the graph, you'll see that these two lines intersect at a significantly higher price point, as demonstrated in this chart. This alteration in supply and demand dynamics led to a considerable surge in used vehicle prices, essentially doubling in just about a year. This, of course, is a simplified explanation of how inflation functions, but it does effectively convey the essential message. Inflation arises when there's an excessive demand for a product or service relative to the available supply in the market. Although many people argue that this inflation is only temporary, Ackman holds a different perspective. He believes we're entering a new normal of sustained higher inflation. Here's what he expressed on Twitter. The world is a structurally different place than it was. The peace dividend is no more. The long-term deflationary effects of outsourcing production to China are no more. Workers and unions' bargaining power continues to rise. Strikes abound, with more likely to come as successful walkouts achieve substantial wage gains. Energy prices are rising rapidly. Not refilling the SPR was a misguided and dangerous mistake. Our strategic assets should never be used to achieve short-term political objectives. Now we must refill the SPR while OPEC and Russia cut production. The green energy transition is, and will remain, incalculably expensive, and higher gas prices will raise inflationary expectations. Just ask your average American. They see the prices at the pump and in the grocery store and don't believe inflation is moderating. To complicate matters further, high inflation likely translates to even higher interest rates to rein in inflation. The Federal Reserve has had to elevate interest rates at the swiftest pace in generations, as indicated in this chart. These actions have been effective in curbing inflation from its peak of over 9%. Nevertheless, if Ackman's prediction holds and inflation proves to be persistent, interest rates will have to climb even higher. These increased rates could exert substantial pressure on stock prices. However, Ackman remains unconcerned, and here's why.
Businesses that can do well in a world of, and by the way, many businesses can do well in a world of 3% inflation. The key is it's hard to manage a business in a world where inflation is volatile, or inflation is 8%, or the kind of crazy numbers. But many businesses can do very well in a world of 3% inflation. And the kind of companies we own, they're very much like royalties.
Here's a breakdown of the list of stocks in Ackman's portfolio. Surprisingly, his $1 billion fund is invested in only 7 different companies, although it's 8 stocks when considering 2 different share classes of Alphabet. These firms encompass various sectors, including Chipotle, a restaurant chain and Restaurant Brands International, the parent company of popular brands like Burger King, Tim Hortons, Popeyes, and Firehouse Subs, Hilton, a renowned hotel chain, Lowe's, a home improvement retailer, Howard Hughes, a real estate company, Canadian Pacific, a railroad company, and Alphabet, the parent company of Google and YouTube. After conducting in-depth research into the businesses present in Ackman's portfolio, it's clear that 2 primary characteristics enable these companies not just to withstand inflation, but to flourish in an inflationary environment. As surprising as it may sound, many of the stocks Ackman owns can perform even better in a high inflation scenario. The first key attribute that aids these companies in navigating inflation is often referred to as pricing power. Pricing power essentially refers to a company's ability to increase its prices without negatively affecting customer demand. To illustrate this concept, let's take the example of Canadian Pacific Kansas City CPKC, one of the stocks in Ackman's portfolio. CPKC operates as a railroad and has a straightforward business model. Businesses looking to transport their products over long distances pay CPKC for this service. Here's a representation of CPKC's network on this map. Imagine you're a company wanting to ship your products from Vancouver, Canada to Laredo, Mexico. Your options are quite limited. You could choose to have your products transported by truck, but that would be highly inefficient and costly. Alternatively, you can opt to CPK services, which are far more cost-effective. This lack of viable alternatives in shipping gives railroads like CPC significant pricing power. They can increase their prices because often they are the only practical choice for shippers. Another example of pricing power in Ackman's portfolio is the restaurant chain Chipotle. Over the years, Chipotle has cultivated a devoted customer base. The company consistently ranks as one of the nation's preferred fast casual restaurant chains. As a result, Chipotle possesses remarkably strong pricing power, especially for a restaurant. Even during the peak of inflation in 2022, Chipotle was able to increase its prices to compensate for the rising costs. Despite these higher prices, the CEO of Chipotle noted that customers continue to choose their favorite meals and buy premium offerings. This ability to set higher prices without losing customers to competitors, as exemplified by companies like CPKC and Chipotle, sharply contrasts with the average business. In the words of Warren Buffett, "If you've got the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to have a prayer session before raising the price by 1/10 of a cent, then you've got a terrible business. I've been in both, and I know the difference." The second crucial attribute to seek in a business is often referred to as being asset-light. An asset-light business doesn't necessitate a significant investment in expensive physical assets to function. To illustrate the concept of asset-light companies, it's helpful to provide an example of an industry that isn't asset-light so you can appreciate the distinction. The airline industry serves as an example of an exceptionally capital-intensive industry. Operating an airline involves a substantial fleet of notably expensive aeroplanes. Airlines invest tens of billions of dollars in procuring these aircraft. Furthermore, these aeroplanes have a finite lifespan and must be regularly replaced with newer ones. Even Warren Buffett. Let's consider American Airlines as a case study. At the end of 2022, American Airlines possessed aircraft valued at nearly $40 billion. What's even more remarkable is that American Airlines holds a market capitalization of only $8 billion. This implies that the value of the aircraft essential for American Airlines to conduct its operations is 5 times higher than the total worth of the entire company. This starkly illustrates the challenge asset-heavy companies face during inflation. They are compelled to allocate ever-increasing sums to replace the substantial physical assets necessary to run their operations. In contrast, Restaurant Brands International, the parent company of Burger King, Tim Hortons, Popeyes, and Firehouse Subs, we observe a different scenario. Restaurant Brands International, often referred to as RBI, follows a franchise business model. In this model, RBI does not possess each location. Instead, these locations are owned and operated by local entrepreneurs known as franchisees. These franchisees are responsible for various aspects, including obtaining real estate, renovating the location, acquiring equipment and inventory, and managing the staff. In return, RBI provides the franchisee with its products, branding, and expertise in exchange for a fee, typically a percentage of the sales generated at that location. The franchise business model offers significant advantages to RBI. It alleviates the need for RBI to invest the substantial capital required to launch and run each location, a cost that can range from hundreds of thousands to several $million, depending on the brand and size of the establishment. This characteristic makes RB an exceptionally asset-light business, as it does not have to own the real estate, equipment, or restaurant inventory. Moreover, the asset-light nature of the business minimizes the impact of inflation on RBI. Inflation can even be advantageous for them. To illustrate, let's assume RBI receives a 10% share of the sales at each location. If a $10 order experiences price inflation over a few years and now costs $15, RBI's 10% share results in a larger sum. Instead of making $1 from the purchase, RBI now earns $1.50, marking a 50% increase. This aligns with Ackman's perspective that you should aim to invest in stocks that function as royalties in an industry. It's worth noting that Ackman is a notably influential figure in the world of investing, with vast experience and a considerable investment portfolio. However, only time will reveal whether Ackman's forecasts regarding inflation and interest rates materialize. In the meantime, you can consider studying his techniques and approaches to master wealth amidst inflation. If you want to learn more about personal finance and generational wealth building strategies, visit our channel and subscribe for more enlightening videos to increase your wealth